Hi, everyone. My name is Miana Miller. I'm the Advocacy Associate at Woodstock Institute, and welcome to Predatory Inclusion, Debunking the Crypto Hype. So, a couple of housekeeping items before we get started. The Q&A function will be available throughout the entire discussion. But while microphones will be muted until the Q&A, you are welcome to leave your cameras on if you wish. And the last 10 minutes or so are set aside for Q&A, during which you can leave questions or unmute and ask your question verbally. With that being said, today's webinar will be a spirited discussion on the emerging harms posed by cryptocurrency's steady creep into the financial system. The discussion will be facilitated by Woodstock Institute's Senior Vice President of Policy and Advocacy, Brent Adams. He has worn many hats as a litigator, lobbyist, political organizer, educator, policy advocate, etc., etc. And in 2009, Illinois Governor Pat Quinn appointed Brent the Secretary of Financial and Professional Regulation, serving as the state's top regulator. And joining Brent is Professor Hilary Allen, Professor of Law at the American University Washington College of Law. Professor Allen is an internationally recognized expert on financial stability regulation and new financial technologies, regularly sharing her expertise with financial regulatory bodies in the United States, the European Union, the UK, Canada, Australia, as well as with international bodies including the IMF, World Bank, G20, and Financial Stability Board. She is also the author of FinTech Dystopia, a summer beach read about Silicon Valley ruining things. And with that, Brent and Professor Allen, I yield the floor to you.
Thanks, Miano. And happy Friday, everybody. Happy Friday, Hillary. And as promised, we're going to start with what you call horse shit.
Mm-hmm.
And in that, by that, I mean stable coins. And first, tell our audience what a stable coin is as compared to, say, a Bitcoin, because stable coins, sound so innocuous and so stable. Go ahead.
Everything's relative, right? So if you start with a Bitcoin, the price of those oscillates wildly because there's nothing behind it. So a Bitcoin literally has no productive capacity, no assets, etc. behind it. It's very Ponzi-like in the sense that it gets its value because someone else is willing to buy it from you, and that's pretty much all there is to it. And if you've got a value that's entirely tied to sentiment, it's very unpredictable and it's going to swing around wildly. And that worked fine for some things. So gamblers really like that. But if you are trying to get something a little more stable into the system, that was never going to work. So they came up with stable coins, which are indeed more stable than Bitcoin, but that does not mean that they are actually stable. So what a stable coin is, it's a crypto asset. And I should have said this up front. A crypto asset is really just a notation on a database, essentially. That's what you're buying, right? And so a Bitcoin is a notation on a database with nothing behind it. A stable coin is a notation on a database that's sort of tied to a reserve of assets. And those assets they include cash held in bank accounts, but they also include other kinds of assets, government issued bonds and sometimes money market funds, a bunch of things that are, relatively safe assets. Their prices don't move around a whole lot, but they still do fluctuate. And as a result, stablecoin prices do fluctuate as well. And even though the reserve is supposed to keep the price of a stablecoin as fixed as always $1, always at $1, researchers have found that they lose their peg all the time. And so it's not always worth $1.
So stable, not so stable.
Yeah, but stabler, I guess, than Bitcoin.
Yeah. So in your book, which I'm going to ask my colleagues to put links to it in the chat throughout the webinar, the discussion here, FinTech Dystopia, a summer beach read about Silicon Valley ruining things. You talk about how a crypto company named Circle, which issues the stablecoin USDC, claims that its stablecoin will help bank the unbanked. Now, this, you say, is horseshit. Before talking about that, can you explain how, from their vantage point, it's supposed to bank the unbanked?
I mean, you've got to understand with crypto that so much of it is driven by narratives, and those narratives don't always sound in reality. And one of the big narratives that crypto has been pushing for a very long time is financial inclusion, right? And they start with a real accurate diagnosis of many of the problems with traditional finance, that people are locked out of the traditional financial system, that they can't always get access to bank accounts. But then they come up with solutions that were never going to work. But you know, it's pretty good PR if you say, you know, people around the world who've been locked out of bank accounts, here is your solution. We have found it. It's this new fancy technology called the blockchain, which is essentially just a clunky database. But we are, you know, it has been so overhyped that people believe it is magic and that it can do anything, include provide financial services to people who've been traditionally excluded from the financial system. What they fail to mention is that if you want to get a stablecoin, you have to buy it, right?
Mm-hmm.
People don't get paid in stablecoins. And if you want stablecoins, you have to buy them, or you need to store them somewhere. It's maybe someone just wants to give you some. You need to store it somewhere. And for almost everybody, the way they buy crypto or the way they store crypto is in an account with an exchange, a crypto exchange, like, for example, Coinbase, which is very special friends with Circle, the issuer of USDC. And so in order to really use stablecoins, you need to have a crypto exchange account, for unless you're like a complete tech whiz who can, you know, do all kinds of things that the vast majority of the population can't do. So you need to have this exchange account. And this is where the rub comes in. Crypto exchanges in the United States will not open an account for you unless you have a bank account. So how can we bank the unbanked if you can't get a crypto exchange account without a bank account? And I actually, you know, it's in the book as you reference. I actually confronted a senior stablecoin executive about this, and he said, you know, you're right, it won't bank the unbanked. And I said, well, why do you keep saying that? And he said, well, we don't. I said, oh, yes, you do. And then he kept on saying it after that. So
Yeah, I wrote in my notes that the only way I could see it banking the unbanked is if they gave it away to a bunch of people
but even
for
then,
free.
But even then, right, if you want to use it to buy anything, most people won't accept them as a form of payment. So you have to convert it into US dollars. And how do you do that? You need to do it on an exchange.
Mm-hmm. Yeah, so even that's not so great.
Oh,
Handed to you on the sidewalk is not.
you know, and in fact, you know, there are Coinbase apparently is doing this to some extent, trying to juice adoption by giving people stable coins to encourage this kind of adoption. But again, they're in Coinbase accounts. And what do you need in order to open a Coinbase account? A bank account.
So I don't know if everyone else caught it, but I heard you say special friends. Can you explain a little bit about what that refers to between Coinbase and Circle?
Well, it's kind of a moving target because the relationship has sort of varied over time. You know, from at one point they were partners, and then there was an equity investment, and then there's contractual interlinkages. But basically, they are very strongly affiliated. I believe currently Coinbase has an equity stake in Circle, and Circle has a strong agreement that there's revenue sharing, I believe. So it's you'll note that with every stable coin that has emerged, well, the big ones that have emerged over the last few years, they were all linked to some exchange. And that's because sort of the goal of them has always been not payments, even though, again, that's a narrative that they like to lean into. But stablecoins really have been used as an on-ramp and off-ramp for speculation in other cryptocurrencies. It's sort of like a place to park your crypto funds in it when you're coming in and out of other crypto bets. And that's, you know, that's a moneymaker for exchanges because they get to charge you fees when you convert things in and out of stable coins. So I think it's no accident that these stable coins have always had some kind of, the big ones that we know of were launched sort of in conjunction with a relationship with an exchange.
Earlier this week, I visited family in Oklahoma, And the only flight to my hometown of Stillwater is via Dallas. And if you've ever been to the Dallas airport, it's sprawling, not unlike the state of Texas. And throughout the sprawling DFW airport was this ad. Rob, can you put up the picture? So this is an ad for the cryptocurrency Texit. It's branded with the Texas flag. And being from Oklahoma, I'm particularly knowledgeable about the long history of Texas seceding from the Union. And Texas and Oklahoma have engaged in armed conflict with one another in the past. And I seriously, right, wondered whether this was start of Texas again becoming its own country, and that this was indeed a Texan currency. But if you stood there for a while, you would see that this ad was it was a scrolling series of ads. It was part of a series of ads for a casino. Now, ironically, in your book, Hilary, you mentioned that a United Kingdom, a UK, happened to be in London, parliamentary committee recommended treating crypto as gambling, not investing. But here in the US, we're going in exactly the opposite direction, right? We're treating crypto as currency. Broadly speaking, now, is that the aim of the so-called Genius Act and the Clarity Act? So now is the time we're going to talk about those two big elephants in the crypto room. And
Sure.
Rob, you can take that down.
So, I mean, just to start, the UK did not follow the advice of their own parliamentary commission either. They've leaned into this being treated as a form of investing, where I firmly do believe it is a form of gambling, because, you know, I think, and just to separate out, I mean, I think the traditional financial system bears some responsibility here for becoming so speculative that sometimes people can't tell the difference between pure gambling and investing. But when you get down to brass tacks, like, investing is supposed to be a win-win, right? You're giving someone money and they're paying you for that money because they can do something productive with it. And that's a win-win. But if you've got something that's more akin to a Ponzi, you're just sort of betting, will the price go up and down? That's zero sum. That's not a win-win. And the crypto industry has for many years been trying to pitch itself as being something more than just gambling, because it needs to keep attracting money. Because, you know, as I said, the whole edifice is Ponzi-like in the sense that if people just stopped buying crypto, it would go to zero. There would be no vestiges other than some burnt out crypto mining equipment in Texas, probably. You know, so there's nothing to be left behind. So the narrative is critically important, and the story that they have been spinning is that this is, you know, empowering, investing, etc. They faced a lot of trouble getting people to buy into that narrative. You know, there has been always a small vocal community that is very into this stuff and likes the story. It's sort of the techno-libertarian kind of ideal. But, you know, very few Americans still to this day invest in crypto. So, you know, the Federal Reserve's most recent survey of household finances, I believe, said it was for 2024, something around the 7% benchmark of Americans touched crypto that year, right? So we're sort of being made to feel that everyone is using this and everyone's investing. And in fact, it's really a small portion of people. And that's not going to sustain it. And so the industry desperately needs this narrative to bring more people in. And so there's been an attempt to make it seem less sketchy, essentially, to encourage adoption. And part of that is through the passage of laws. And so we've had one law passed already, the Genius Act, which sort of legitimizes stable coins. It creates a situation where, and this law has to be implemented through rules, and the rules haven't yet been written, so we don't know exactly how it's going to shake out. But basically, it sets up a structure where stablecoin issuers can issue these stablecoins. They look a whole lot like a deposit from a functional perspective. They are, I would argue, economically susceptible to runs the same way that bank accounts are susceptible to runs, but then none of the protections are there. So you don't have deposit insurance in place to try and stave off runs. You don't have a lender of last resort who's available to lend to stablecoin issuers to deal with liquidity crunches. You don't have a special resolution mechanism that prioritizes stablecoin holders if there is a run. You have lighter touch capital regulation, things like that. So it's just, I don't know how to describe this bill other than as a crypto industry wish list. And it is poorly thought out. Things that are so obvious are going to happen are not catered for. But the goal really is to legitimize these and to try and get people to start using them more.
Before you talk about clarity, have we already seen what you would characterize as runs on other crypto assets or crypto coins, but in terms of the crypto Bitcoin winters and those things that have happened, can you tell us about those, how those are represented runs or what have you?
Yeah, so the classic, if you're not familiar, the classic run dynamic is that you have a bank and you put your money in the bank, and then the bank lends it out to other people, and the bank doesn't need to have everybody's money on hand. It can lend it out because odds are most people aren't going to try and get their money back at the same time. But in a panic, the calculus changes, and then everybody wants their money back, and the money is actually locked up in all kinds of other investments, and trying to liquidate those investments quickly, like, you can't call in a 30-year mortgage, so you have to try and sell it to someone who will take it off your hands, but they're not going to give you 100 cents on the dollar. And so by selling off your assets, they become sort of, in a panic, they become worth less and less and less, and suddenly your liabilities exceed your assets, and then you sort of can fall into bankruptcy. That's sort of the worst case scenario of a bank run. As we saw in 2008, they don't just happen in banks. We've had runs on money market mutual funds. We have runs on sort of institutional debt arrangements known as repo. And these kind of dynamics also showed up in the crypto industry. So in 2022, we had what's known as the crypto winter. So there was a run on the Terra stablecoin, and that collapsed as people ran to get their money out. It was a little different from the stablecoins I mentioned or at the top of the hour, because it didn't even have a reserve of assets. It had this sort of weird algorithmic incentive mechanism that was never going to work, I don't think. But anyway, unsurprisingly, it failed. But then so many other parts of the crypto system had exposure to Terra Luna that they started to fall like dominoes as well. And then the biggest domino to fall was in November of 2022, and that was the FTX exchange. And that also you can think of that as a run, because what had happened was FTX was taking its customers' assets and giving them this FTT token in exchange. And the FTT token was its own, what we call native token. So it's got its own sort of, how would I describe this? Yeah, basically it can create this out of thin air. Basically said, like, we are going to issue a whole bunch of FTT tokens. They're not backed by anything, but they're linked to our exchange. And we think as our exchange becomes more valuable, they'll become more valuable too, but there's nothing behind them. It was sort of the idea. And so they were taking customer crypto assets and giving them these FTT token in exchange. And customers didn't know that. It was just happening internally on their books. And so long as only a few customers were trying to get their other crypto assets out of FTX, it was fine, because then they would exchange the FTT for the other crypto assets and give them that, and that all worked fine. But suddenly, when there started to be questions raised about FTX's solvency, everybody wanted to get their crypto assets out of FTX, and it didn't have enough, and started selling off what it did have, and it didn't have enough to satisfy what it said it was holding for people. And so that was a run there. But I think the most sort of classic run dynamic is we saw in 2023. So when Silicon Valley Bank failed, $3.3 billion of the USDC stablecoins reserves were with Silicon Valley Bank. And so it lost its peg. I can't remember exactly how far down it went. It was like, I think below 90 cents on the dollar. And I would submit, although I can't, I mean, this is just an opinion, but that had the government not stepped up and bailed out Silicon Valley Bank's uninsured depositors, which it did, if it hadn't done that, then I'm not sure the USD coin could have survived, because $3.3 billion of its assets were in this legal limbo, and they may not have been available, for a long time because they would have been caught up in Silicon Valley Bank's resolution process, et cetera.
And so the lesson here is that could happen again.
Yes.
Yes. I noticed recently you mentioned that before returning to clarity, again, the genius, I'm trying to keep track of this. The genius, they have those ridiculous acronyms, which I don't understand why they feel compelled to do those things. But at any rate, genius is stablecoin. So the Treasury did issue an advance notice of proposed rulemaking on the 18th. So they are moving. They are moving fast, and they have years to get this done. And I was going to ask you about this later, but I feel compelled to do. Can we put the toothpaste back in the tube once this is done? Like, is there undoing this once this is done?
Well, I mean, it's a political economy question, right? Because legally, of course you can. You can ban all kinds of things. We do it all the time with things we think are noxious. The political economy question is a difficult one, which is, once you start to have an ecosystem of participants whose businesses rely on these, then it's really hard to put the toothpaste back in the tube. So I think short of something really terrible happening, but even with something really terrible happening. So, for example, there's actually a really parallel story we can tell here about swaps, a type of derivative contract, right? So back in the late 90s, the swaps market was taking off, and a regulator, Brooksley Bourne at the CFTC, said, "Ooh, maybe we should look at these." And she was basically piled on by every other regulator, and the Treasury Secretary at the time was like, "No, get out of the way. These are sophisticated participants. Technology has changed things. Oh, brave new world. Don't stop innovation." Just the exact same talking points. And so she was basically, her concerns were shunted out of the conversation, and even more so, they ended up passing a law, the Commodity Futures Modernization Act in 2000, which said you can't really regulate these things. They are for sophisticated participants, et cetera. So there are people who are calling the Clarity Act, which we'll get to, CFMA 2.0, right? That is just like the Commodity Futures Modernization Act. It's a step by Congress to say, get out of the way, let this market just flourish. Now, these swaps ended up being a major ingredient in the financial crisis of 2008, but this is why I bring this up. The response was to regulate them more, but never to try and put the toothpaste back in the tube. And so I think that does not augur well for, even if there is a massive blow up of stable coins, that we'll try and actually put the toothpaste back in the tube. We'll probably get better regulation of them after a big blow up, but I think they should have been banned from the get-go.
Yeah, a very smart person at a very smart organization said that their approach has been to just try to avoid dealing with crypto in the hopes that it would just be some fatty thing that went away. And that apparently is not going to be the case. And that it looks like stable coins, at least, are going to be part of the American consumer financial ecosystem. Maybe I put emphasis on consumer. So not Wall Street ecosystem that, derivatives, for example, like consumers and derivatives oftentimes will never have something to do with one another, but that the American consumer experience will have something to do with stable coins come, 2030. Is that fair to say?
It's funny you put it that way, because I'm not sure. Because even though this is pitched as a consumer product, a lot of the interest in it is more at the institutional level. People talking about these kinds of products are the people who are in the derivatives markets, right? Because they're being used. I think a lot of the vision is for these to be used as what we call settlement assets for really complicated, pre-programmed, bespoke financial products that have like one leg in the traditional financial markets and one leg in the crypto markets, and we use smart contracts to pre-program them all. That's where I see a lot of the interest. They're definitely pitched as a consumer product, but consumers actually get to choose whether they use these things or not, and they're really not great as a payments mechanism. So, I mean, for a number of reasons. I mean, first of all, they can be quite expensive, because even though, so when you hear the sales pitch about them, they say, it doesn't cost much money to send money on a blockchain. That is sometimes true, but it's also sometimes not. The fees for making payments on a blockchain fluctuate depending on how much it's being used, right? So at peak traffic, your fees can be quite expensive for sending money on a blockchain. But that neglects the exchange fees that I mentioned right at the beginning of this, right? Every time you turn your money into or out of a stablecoin, you pay a fee to the crypto exchange. And when you factor all that in, it's often quite expensive. It can also be quite slow. Again, we're told all the time that the blockchain is so speedy. Actually, it's not. It gets congested. It can be quite slow. And in El Salvador, they made Bitcoin currency for a while that you could ostensibly spend anywhere in any store. And people didn't use it in part because it was just taking too long. No one could sit around and wait for 10, 15, 20 minutes, a couple of hours to buy their coffee, right? So, and stable coins aren't as volatile as Bitcoin, but they have that same, they run on the same kind of rails. And there are people trying to build rails on top of blockchains that will maybe be faster. So I'm like, well, then why are we even doing this? If we're not using the blockchain in the first place. And then another thing that customers really need to be aware of is that you can't reverse transactions on a blockchain. So if you mistakenly send something, it's gone. And, that's a really scary prospect. There's all kinds
That's a huge takeaway for folks who are listening. It's gone.
Yeah, it's gone. And there's all kinds of consumer protections we have built into other types of payment mechanisms, things like chargebacks, et cetera. You're forfeiting all of that if you use stablecoin for a payment. And so there's just not that much of, I think, of a consumer use case. Also, people's payment habits are sticky. Like you have to be really much better than what's available to get people to adopt. And so I don't see it really taking off with consumers generally, unless it's sort of being forced upon them. I would say another thing that consumers should be aware about, as I said, is that these aren't insured the way deposits are. And so when you have Bank of America saying how they're going to launch their own stablecoins, they're going to have an uninsured stablecoin alongside their insured deposit. That's going to create a whole lot of confusion for customers, and that's something else.
And they have done that. That's not a hypothetical. That's happened.
No, it hasn't happened, but they have said they want to do it. So it's not a pure hypothetical, but it has not yet come to fruition.
Okay.
Yeah. So, I mean, the one thing that I think is particularly dangerous about the Genius Act, and I hate these acronyms too, by the way. I think perhaps we could spend more time on the actual bill itself rather than the acronym.
It's a strained experiment. Why are we doing it? Yeah, I agree. We don't do that here in Illinois. Anyway.
Yet. One of the things that has been flown under the radar there is that for the first time, it allows non-banks, like commercial businesses, to offer you an equivalent to your bank account through a stablecoin. And so I think if these do take off, it'll be because the largest tech platforms want to have an in-app payment system. And we may see that it take off for that reason. So all of that is a very long way to say that I think the toothpaste is out of the tube, but I think that the main use case for these is actually going to be with the sophisticated financial institutions. And I don't see a lot of appeal to consumers, but, we've seen that, you said, how do we were, plenty of people, myself included, were hoping that crypto would die and go away. The reason it didn't, particularly after the crypto winter in 2022, was that you had venture capitalists with huge amounts of money that they had raised to invest in crypto. They already had a lot of crypto investments, and then they just started using that money for lobbying, for media. They hired a lot of people from the government. It was a real revolving door situation. So it was really sort of survival of the fittest was not what was going on here. This is the evolution process of, the Darwinian evolution was disrupted, if you will, by just throwing a whole lot of money at trying to keep this thing alive. And so I don't know, maybe they'll throw more money at trying to force adoption with consumers.
Well, a sort of a way to look at it is this sort of an emperor's new clothes situation. Like this whole crypto thing is like the only and I think you've said it this way, if not in a conversation with me, or maybe today, that its value only stems because someone says it has value and someone believes them when they say it has value.
Yeah, no, that's right. I mean, and that's why I call it Ponzi-like. I mean, so look, stock market prices are not rational. We can look at the AI bubble right now and see that. But typically, a business has premises, employees, revenues, some kind of revenue, something like that. And crypto has none of that. So it really is. I am one of the many, many people who have said this is an emperor news clothes situation, because, as soon as someone admits that there's no there, the whole thing could very well go to zero like that. And actually, someone pointed out to me, it's sort of worse than it going to zero, because there's always expenses associated with liquidating these things and figuring out, how to wind them up. And there's not even any assets that are available for that purpose. So it's sort of, it could go to less than zero, like that. But I think, I'd actually make this point in FinTech Dystopia. I think, when my kids watch the Emperor's New Clothes cartoons, the kid at the end says, "Hey, the Emperor's not wearing any clothes. He's actually naked." And everyone goes, "Yes, that's true. The Emperor isn't wearing any clothes. How silly were we?" But in the real Hans Christian Andersen version of the story, the higher ups never admit it. Right. Because I think that's probably a realistic situation of where we're at. Some of them always knew it wasn't true and were just being cynical through and through. And then others will probably never admit to the reality.
Now, I think there's an element of this in the Genius Act, but I think this is also a good way to segue into Clarity Act, which seems as though these bills are creating all these incentives for mainstream finance to get involved by stripping away consumer protections that are so burdensome, right? You don't have to comply with this, you don't have to comply with this, don't have to comply with this, to make the mainstream financial institutions get into this game and offer these accounts, which the consumer may or may not know are lacking in all these consumer protections. Can you talk about that? And then in that context, talk about what clarity is?
Yeah. So, avoiding consumer protections and other laws is basically the ball game when it comes to crypto. So I've talked a little bit about this underlying blockchain technology and said that it's just a clunky database, and it really is. It is more expensive, less efficient, et cetera, than your average database that you would use to record financial transactions. So the crypto industry was never going to find a competitive edge in using this technology just because of the technology, right? But what it's been very successful in doing is weaponizing narratives about the technology to get special legal treatment, or at least to discourage regulators and from enforcing existing laws, right? So the ball game is operating on an uneven regulatory playing field, where you don't have to comply with consumer protection laws, investor protection laws, money laundering laws, tax reporting laws, et cetera. That's really the raison d'etre for the industry. And so when you look at what's happening with Genius and Clarity, is basically trying to get it made permanent that the crypto industry does not have to comply with the same laws as everyone else. The problem, though, is that, well, there are many problems with that, but one problem that I think we need to focus on is that there's nothing particularly special about crypto. As I said, all of this is sort of hype and smoke and mirrors and narrative, et cetera. But when you get down to brass tacks, when you're selling a crypto asset, like, how is that different from selling any other security? You're trying to raise money from investors. They're not actively involved in what you're doing. You're promising them some kind of return. It fits very easily into the framework of the securities laws. And yet the crypto industry has always wanted to not be regulated by the securities laws. And so what they're trying to do in Clarity is find a way to say, crypto isn't regulated as a security. Now, there's no way to do that other than tying it to the technology, because as I said, there's nothing very special about crypto assets other than that they live on a blockchain, which is a clunky database. So every attempt that we've seen at market structure bills, and that's sort of the global name for the Clarity Act and its predecessors, every attempt has tied the availability of the loophole effectively from the securities laws to using a blockchain. In other words, if you put your assets on the blockchain, they stop being securities, the SEC loses jurisdiction. So yes, absolutely, the goal is to get rid of the investor protections of the securities laws when it applies to crypto assets. But I don't know if it was inadvertently or advertently. What they're doing by doing that is basically saying, hey, rest of the financial industry, you want to avoid the securities laws too? It's very simple. Just use a blockchain. And so they're trying to, so what that does is it encourages all of our traditional financial products and markets to sort of migrate onto this very clunky and inefficient database, which has all kinds of operational risks that I've written about at length. I won't go to that down that rabbit hole here, but just in terms of plumbing, it is not the plumbing that you want your financial assets recorded on, trust me. Anyway, so it is going to eviscerate, if Clarity becomes law, it will eviscerate investor protections, not just for crypto investors, but eventually, as all the traditional markets sort of bleed onto this, onto the blockchain to take advantage of the Clarity X loopholes, it will eviscerate investor protections for everyone.
So before we get to Q&A, I'm kind of trying to bring a focus to the folks that a lot of us on this call and folks that Woodstock focuses on, which is lower income folks, Black and brown communities, folks who are invariably going to get caught up in this web, or who are in the web.
Yep.
Not the web, but you know what I mean, this web, and who are going to get taken down when the ship collapses, when the house of cards falls, or when all kind of things. So is there a buyer beware message you have here, which is that when inevitably we are all offered these crypto accounts from these mainstream financial institutions like Bank of America, et cetera, that have all these new enticements, of which I not even know what they could be, you might know what the enticements might be. I mean, they already have no fee X, Y, and Z, so I don't know what the enticements might be. But is the buyer beware here to just say no? Go with the dollar, go with the mainstream deal, stay away from crypto. And when it comes to your bank account on all those kinds of things.
Yeah, I mean, absolutely don't substitute stable coins for your bank account. And if if you need any convincing on this one, I mean, I think we can look at what happened either last year or the year before with Synapse. So for those of people who aren't familiar, Synapse was a fintech middleman. It sat between Evolve Bank and a few other banks and a whole bunch of these sort of neo banks, things like Yoda and Mercury and Juno. And basically people, all of those neo banks they're sort of smartphone based or web based, and they marketed themselves in particular to a lot of communities that had Black and brown communities who'd been typically excluded from other financial services. And what happened was the money was supposed to be eventually put in Evolve Bank, which had had deposit insurance, but the neobanks didn't have deposit insurance, and the Synapse failed, and its record keeping got scrambled, and basically it wasn't clear whose money was where. And so lots of people, it was a huge consumer protection issue that didn't get enough press, in my view. Lots of people lost their money outright. Lots of people had their money locked up for months before they could get a hold of it again, because it wasn't insured. And, and this is, and they thought it was. And so I'm particularly concerned that these stablecoins will be marketed to people as, with all these stories, like this is stuff that is better, designed for your community, better than, traditional banking, because, we're not those evil banks. We're these like cool, hip tech folks who care about financial inclusion in communities like yours. And it'll be marketed that way. And people won't realize that they don't have deposit insurance. So
I guess I can imagine them saying you get 100 stable coins as a giveaway when you open an account.
And what they will do then is they will encourage you to use that to bet on crypto, because that is the point. So they will give you these and they'll say, and as part of that, you can use it for payments, and also you can, dabble in a little crypto speculation, because again, that is being marketed, especially to Black and brown communities, as a way of, getting generational wealth. We hear that thrown around a lot. And it is, again, this industry does very well. Something it does very well is it targets real issues, which is that, yes, Black and brown communities absolutely have been locked out of opportunities to develop generational wealth. But this is not it, right? These, the big fish almost inevitably win. The people who are the early investors do well. People who come in late usually lose money. People who bought in the sort of the 2022 bubble, I mean, the vast majority of people who bet on Bitcoin lost money there. So, it's essentially they're looking for bag holders, and they're using narratives of, this will build you generational wealth. If you don't take advantage of these opportunities, it's your own fault for not sort of taking responsibility for your finances, et cetera. I highly recommend Tanansin Carmona at the Brookings Institute did a really great piece on debunking the crypto hype when it comes to financial inclusion, particularly for traditionally marginalized communities. And I can't recommend that highly enough for why, all of these narratives are so predatory.
Nancy used to be at the city clerk's office, and we worked closely with her on stopping the depriving people of driver's licenses for fines and fees. So we know we're friends with Nancy. So, so there's a question, but before we get to the question, the more and more we talk about this, the more I sort of analogize crypto to like sports betting. And indeed, you talk about in your book how there was a period of time where you're writing Amtrak a lot. and you saw the proliferation of crypto ads alongside sports betting ads. And in that context, you use the term financial precarity. Can you give a little context about what that term means in the context of crypto?
Yeah. So just as an anecdote, one person explained an origin story to me of crypto, which I think tracks, which is that it really took off in 2020, which is when there were no sports games being played and therefore none to bet on. And so the people who had a gambling itch were scratching it with crypto, and that's sort of part of the origin story of crypto. But I think there are people who will always gamble. I mean, gambling has been around for all of human society. But I think it's been documented that in times of financial uncertainty or just general uncertainty and economic precarity, then you're likely to see more gambling. And so these are people who are not necessarily just gambling, they wouldn't necessarily be gamblers always. But when you are in such a, when you are one medical bill away from penury, essentially, like, does it make a little more sense? It's a lot like buying a lottery ticket, right? I think through this economic precarity, they've forced people who otherwise wouldn't be interested in gambling to be really looking for a Hail Mary, because you've got half of all Americans living paycheck to paycheck already. And that's before this one big beautiful bill, or whatever we're calling it, cuts in and takes away people's health insurance and makes it harder to get SNAP assistance, et cetera. So people's lives are only going to get more precarious. And it seems like the only thing that can insulate you from all of that is wealth. And to some extent, that's true. But you're not going to get that wealth, or the vast majority of people aren't going to get that wealth by gambling. But it seems like the only lifeline. And that's, I think, a real indictment of where we are, one of the many real indictments of where we are as a society, that this seems like the only lifeline for some people.
Yes, it reminds me, it's only tangentially kind of related, but one issue that we've been trying to address, is like item number 33 on our list of priorities, are these live checks. They send folks, high interest lenders get lists of folks with certain credit scores who are likely to be in a situation of financial precarity, and they send these live checks that are effectively marketing, expecting that the person receiving the mailer is going to be in a situation where they need money, and they're going to see, so they're waving this check in front of their face, and they're more likely to then just endorse it and take it to the bank and then get a high interest loan that they would have never gotten. Had the
Wow.
live check not been, that the live credit cards have been illegal for decades, but live checks are still legal. So anyway, it reminds me of that. So the question, first question, do either the Genius or Clarity Acts provide enough room for states to step in and try to regulate crypto? And before you answer that, it's kind of implicit in the question, can you tell us where Clarity stands? Clarity is not law. Was that correct? It's still in the sausage making process of Congress, whereas Genius is. Do you happen to know, is Clarity just stuck in between chambers right now? Is that where Clarity is at?
So Clarity's passed in the House, and they need a Senate bill, and the Senate bill was supposed to move in September, but it's behind, which to my mind is a good thing. So it's actually really interesting, because the traditional financial institutions frankly got screwed by Genius, because Genius, it says that stablecoin issuers aren't allowed to pay interest on the stablecoins, but it didn't say anything about whether their special friend exchanges could pay interest. And so in fact, it sets it up for Coinbase to essentially pay yield on the USDC stablecoin. And banks, for whatever reason, were asleep on that and missed it. And now they're trying to use Clarity to clean that up. I don't like their chances, but they're getting help. And then traditional, like, financial brokers and things like that, are deeply concerned about what clarity will do to the traditional financial markets. Like, so I mentioned before that it'll create this huge loophole. If that loophole is created, they will rush into it. But they know in the long term that that's bad news for trust in the markets, because if investors don't trust the markets at all, they're going to pull back. And so the largest financial institutions are starting to sort of awaken that this is a really bad thing. And so the politics around clarity have become more complicated. So I still think it's probably going to pass because essentially the crypto industry paid for it. You know, they almost half of all corporate donations to candidates in the 2024 election cycle came from the crypto industry. And they've got even more money, you know, earmarked for the midterms in 2026. So, I mean, I think they're going to get what they want. But the politics has been complicated a little bit because the larger financial institutions are starting to wake up. So to go to the question on that, on where the states fit in this. So NASA, the National Association of Security, I don't actually know. It's the state. It's no. Anyway, I wish I knew what it stood for, but it basically state securities regulators. It's an umbrella organization for them. They have submitted a letter, and I've actually signed on to it, about, you know, the importance of maintaining state protections and not preempting them in the Clarity Act. We'll see how that goes. Genius, I'm not sure how, I should know this, but I don't know how it goes on preempting state consumer regulation. What it does, though, is allow a race to the bottom by the states to a large degree. So there's a lot of flexibility for state-issued stablecoins to have lower standards for consumer protection, amongst other things.
That's a good question about the stablecoin and the preemption piece. I mean, we have a new crypto law that hasn't gotten off the ground. Digital assets, we like to call them, so as to not give, you know, too much, to not add to the crypto hype, frankly.
Yeah, no, I agree.
Yeah. Is there a risk? Is there a risk for the crypto market to be so heavily invested in treasuries? Is the next question, which I don't even fully understand the import of because I'm not an expert in that particular arena. Can you explain that question to us?
Question. Sure. Yeah. So I think this is a question about stable coins. So stable coins, as I mentioned, have a reserve of assets that are supposed to help keep the value closer to that $1 peg. And I mentioned that some of it's cash, but a lot of it is treasuries. So treasuries are, you know, bonds issued by the US government, essentially, and they're seen as pretty safe assets, pretty stable assets, that their value doesn't fluctuate a lot. It does fluctuate sometimes. And we've increasingly in the past sort of, I don't know, 10-ish years seen some hiccups with regards to treasury markets, you know, people, you know, flash crashes and things. And so, but because these treasuries are seen as sort of the epitome of safe assets other than cash, if there is a problem with their prices, the ripple effects are enormous. All kinds of financial markets are built on these things, and the ripple effects are unpredictable but huge if there's a problem with their price. So one of the concerns that has been raised about stablecoins is if they are buying more, and so remember, every time someone buys a stable, you know, if they're going to mint a new stablecoin, they need to back that. So they need to buy more treasuries and other assets. So one of the sort of conversations that's happening is that as foreign countries don't want to hold US treasuries so much anymore, imagine that, that stable coins will be the ones that fill the breach. But what that means then is if we really have huge amounts of our government debt owned by a stable coin, and then there's a run on the stable coin, and the stablecoin issuer has to start selling off the assets in its reserve, then that could really mess with the treasuries markets, depressing their prices, their market prices. And then that is going to have so many ripple effects, as I said, because these assets are so integrated and their prices are so integrated into so many other markets.
Now, this next question I do understand, which is if the plumbing is so rickety, as you imply, which I think the problem is rickety everywhere. Is crypto stable coins exposed to cyber security risks like hacks and custodial breaches?
Yes. I mean,
Yes.
no, big time. Yeah, no, crypto. So if you're interested in sort of hacks and scams and etc. with regards to crypto, I highly recommend Molly White. She's an independent journalist. She has a sarcastically named website called Web3 is going just great. And Web3 is like part of the marketing hype of crypto. Like we're going to build the third version of the web using this. Anyway, so that's why it's called Web3 is going just great. And she's got a running tally of all the hacks, the scams, etc. in this space. And so there are all kinds of vulnerabilities that do get exploited regularly in the crypto space.
Yeah, even the non-rickety plumbing gets hacked, in my experience.
Yeah, but it absolutely does. I mean, I would say, so the difference is that with the non-rickety plumbing, you have individuals who can be held accountable. But with the blockchain, I don't want to overstate this here because there are absolutely people you could hold accountable, but we've sort of collectively decided that those people aren't really in control and therefore can't be held accountable. So if something happens, there's no one to turn to say, like, you need to fix this, you need to get this up and running again quickly. Why didn't you invest more in cybersecurity? There's no one to really sort of hold liable. I mean, as I said, there are people there. We could decide to do that, but none of these laws are even touching that.
So with 2 minutes left, a big takeaway here, I think, is what I surmised you would say, which is like, it's not time to start, turning your deposit account into a stable coin account anytime soon or in the foreseeable future, if ever. So, we're with you there. What other kind of takeaways would you say, generally speaking, like tips for listeners and consumers who might be considering venturing into this realm?
So it's tough because I think we're getting to the point where this stuff is probably going to cause a financial crisis. So that even if you never touch this stuff, you're not going to be protected from it or from its impacts. So, my cheesy answer is what you should do about this is vote. There was a group chat amongst crypto industry folks and high profile Democrat lawmakers right before Genius Act passed. And one of the blockchain lobbyists said on the group chat, and this got exposed, I think Semaphore got a hold of, or no, the Lever, I think, got a hold of it and published the article. But one of the people from the crypto industry said, look, no one is going to primary you just because you voted for Genius. And so they were sort of basically saying, why antagonize us, if no one is going to even notice that you did this? And so there are these rankings, standwithcrypto.com, and it's a bit like the NRA's rankings, where the crypto industry basically rates people who are crypto friendly and not, and uses that to put a target on people. I say, let's make lemonade out of lemons and reverse that. And if you want to see if your candidate is doing right on this issue, if they get an F from Stand with Crypto, you should reward them. If they're getting an A from Stand with Crypto, maybe it's time for a primary challenger, but yeah. Otherwise, I guess my message is very much the Nancy Reagan approach, which is just say no. Just say no to crypto for your own personal finances and investments. And look, sometimes it's going to feel tough. Sometimes it's going to feel like you're missing out because the FOMO is real. You're going to hear about the one person who made bank. But you know what? That was exactly how the 1920s went down as well. We didn't have social media, but people would gather, they'd talk over their fences about, like, did you see this latest hot investment that I got? Or did you hear Tom down the street made this much money on this? And people rushed in, and then everyone lost their shirts.
Well, thank you so much, Hillary. And you're not going to hear about the person who did poorly. They're not going to be rushing to point out to that person's misery. So, thank you so much for all your time. It's been a pleasure talking to you. I hope we get to talk some more about this because I'm sure it's not going to go away, unlike my friends at that organization hoped it would. So, with that, have a good evening for those who happen to be in London, and for the rest of you all, have a good afternoon.
Thanks so much.
Thank you.